Namaste, good morning. Welcome to this session where we are going to look into complete the remaining three questions of PGBP and then walk and understand into capital gains fully. Without wasting time, let's go into the session. We started reading this particular question. We started reading this particular question the other day and said that in this tiredness, let us not do, let us understand it from the base of it. So, oh, I once again read that question to start with. A company engaged in manufacturing. The profit and loss account is 905 lakhs before depreciation. The following informations are provided. Information 1 is with regard to purposes. Okay. Information 2, section 41, cessation of trading liability or write back of creditors, which should be considered as an income in the hands of the assessee. Information number 3, 43B adjustment. Whatever is paid during the year, that year you would have disallowed the entire interest. The other year you would have disallowed the entire interest of 8 lakhs. Now 2 installments are paid, so we should allow. The next adjustment is TDS default. You have not remitted within the due date, disallowance. The next adjustment is with regard to Saurashtra Cement's case, where any liquidated damages received shall be treated as income, shall be treated as adjustment to the value of the asset. Next is 40A3 allowed. The seventh adjustment is term loan waiver, which needs to be adjusted with the cost of the asset. Sale case law, SAIL. Okay, sale case law. Electoral trust is like an political party. Expenses not allowed, deduction can be later claimed. Whatever is the equipment value and building value for scientific research can directly be claimed. Land cannot be claimed as deduction. And then the asset details are given. It is a manufacturing entity, so we should claim normal and additional depreciation along with few things which I want. That's why I said fresh we will take up today. Can you quickly go through the questions so that I can go to that? First, let us work out depreciation, especially for plant and machinery. Okay, I'm going to work out in absolute value, not in crores or lakhs, in absolute value. I'm going to work out. Okay, I want the class to join with me to work out. I want the class to work out along with me. Okay, it will be a good thing to learn, but don't go fast. Work out along with me. To use for 180 days or more. Okay, company purchased 9 crores and 11 crores in September and December. An old machine was sold for 15 lakhs. Now, all of us, I want you to concentrate. All of us, I want you to concentrate according to Saurashtra cement case. According to Saurashtra cement case, liquidated damages received on uh, on plant and machinery, in fact on asset, okay, shall be adjusted with the cost of the asset. It should not be treated as income. It should be adjusted with the cost of the asset. So we saw here in adjustment number 5, liquidated damages 3 lakhs for delay in supply of plant and machinery. So this should be adjusted with the block value. This should be adjusted with the block value. Whenever liquidated damages are received, okay, which can be intricately associated to an asset, which is directly related to an asset, please adjust it with the asset value. Don't take it as income. According to Steel Authority of India Limited, according to sale case law, okay, where term loan pertaining to an asset is waived by the bank, then the waiver shall be adjusted with the cost of the asset. Okay, with the cost of the asset. Wherever there is a term loan. In this case, okay, there is a term loan which has been, as per the scheme, 50,000. Okay, we have assumed it as term loan. Suppose you can have an alternative assumption that it is a working capital loan, in which case it should be taken as part of income. I have taken it as part of term loan. Okay. Otherwise, the other thing is taking it as part of income. Now I am taking it as term loan and working. Okay, so these two adjustments are very essential to understand. Only after doing this adjustment you should do the depreciation. Only after doing this adjustment you should do the depreciation. Remember please, balance available for depreciation less depreciation, okay, normal depreciation, all of us together, okay, 11 crores into 7.5% plus, okay, 30 crore 81 lakh 50,000 minus 11 crores into 15%. Repeating, 11 crores, that is the asset which is put to use for less than 180 days into half the rate, 7.5%. So out of 30 lakhs, I have claimed for 11 lakhs. Balance 19 crore 81 lakh 50,000 into 15%. Additional, please understand, 9 crores into 20% plus 11 crores into 10%. Additional, whatever additions made during the year. So 9 crores into 20% plus 11 crores into 10%. Okay, this is the total depreciation. Okay, for plant and machinery. This is the total depreciation for plant and machinery. Closing WDV, closing WDV is this much. Closing WDV this much. Please understand, total depreciation, okay, will be, okay, plant and machinery plus for other assets, the question itself gives for all other assets according to income tax law, it is 14 lakhs plus 14 lakhs. What is for other assets? Okay, other assets. For plant and machinery, we have computed this one plus 14 lakhs for other assets. Okay, this is the total depreciation that can be claimed. 6 crore 83 lakh 72,500. 6 crore 83 lakh 72,500. Okay, we all know to end with the note for asset purchased and put to use. For asset purchased and put to use for less than 180 days, additional depreciation. Balance additional depreciation of 10% can be claimed in the immediately succeeding year. Balance additional depreciation of 10% can be claimed in the immediately succeeding year, that is 21. For that 11 crores, I only claimed 10%. For that 11 crores, I only claimed 10%. Balance 10% can be claimed. If we write this note and end it, it will be nice. So remember, we covered Saurashtra Cement case, Steel Authority of India case, and we also understood again how to compute depreciation. We also understood how to compute, how to adjust these things in the block. One of the things in examination or general working which we will come to our mind is this 3 lakh not relating to that 9 crores or 11 crores purchased during the year? Unless they give it, don't take it. Unless they specifically say it is for this particular asset, don't reduce it, compute it, do it as simple as possible, but be confident it will be correct. Computation of business income. Computation of business income. And absolute values I'm doing. Okay, I'm doing it in absolute values. Okay, net profit as per profit and loss account. Okay, net profit as per profit and loss account, 9 crores 5 lakhs, 9 crores 5 lakhs. Adjustments. First adjustment is very interesting. It is with regard to, the first adjustment is with regard to perquisite. According to section 28, any perquisite received by the assessee shall be treated as income irrespective of whether it is convertible into money or not. It will be income in the year of accrual. Okay, any perquisite will be treated as income irrespective of whether it is convertible into money or not, and it will be treated as income whether you can convert it into money or not. Do it on due basis. According to section 41, trading liability foregone by a creditor shall be treated as income. According to section 41, trading liability foregone by a creditor will be treated as income. Trading liability foregone by a creditor will be treated as income, shall be treated as income. Accordingly, rupees 2 lakhs, okay, accordingly, rupees 2 lakhs foregone shall be treated as deemed business income. They have not treated it as income. No impact has been given in the running account. We need to give. We need to give. Okay. The third adjustment. The third adjustment speaks about 43B. What is that adjustment? They have converted a term loan in the interest arrears into a term loan payable in 10 equal installment. 8 crores worth of interest were in arrears, which has been converted into a term loan, of which it to be repayable in 10 installment. 2 installments is repaid now. What is the sanctity of this adjustment? The adjustment just leads us for 43B, since the interests were in arrears of the past years, in those years it would have been disallowed. Since the interest were in arrears for the past years, in those years it would have been disallowed. In the current year, it should be allowed. Repeating, since these arrears of interest is for past years, in those years it would have been disallowed. In the current year, it should be treated as income. In the current year, it should be treated as income. Okay, expenditure. In the current year, it should be treated as expenditure. According to section 43B, interest disallowed in the previous years as it is not paid within due date shall be allowed in the year of actual payment. Rupees 8 lakhs would have been disallowed in respective preceding years. So this 8 lakhs would have been disallowed in the respective preceding years, shall be allowed in the current year as 2 installments are paid. So allowing will be 8 lakhs divided by 10 into 2. Repeating, 8 lakhs divided by 10 into 2 will be allowed 1,60,000. They have taken it to the funded interest account in the balance sheet, but actually it should go to P&L. They have taken it to the funded interest account. You have paid 2 installments this year. Whatever has been paid during the year will be allowed. That is the main aspect of provisions under 43B. Okay. TDS default remitted after due date. Okay. Payment to a non-resident on which tax has been deducted but remitted after the due date of filing returns. 100% shall be disallowed. However, the same will be allowed in the year in which default is rectified. That is, you can claim this in 21-22, but this year 100% of the expenditure is disallowed. That is, this 5 lakh is disallowed. 5 lakhs is disallowed. 100% of the expenditure will be disallowed. So this entire 5 lakhs is disallowed, my dear friends. Liquidated damages has been shown in other income in P&L. In Saurashtra cement case, it is held that any compensation which is directly linked to an asset shall be adjusted with the cost of the asset. So it should not be treated as income. We all just noticed. So the entire 3 lakhs will not be treated as income. It will be adjusted with the cost of the asset. So reduce it from the P&L because you have taken it as income. Reduce it as from the P&L and also reduce it from the asset value. Okay. According to section 48(3), any payment on a single day to a particular person in excess of rupees 10,000 otherwise than by approved modes. Okay, otherwise than by approved modes shall be disallowed. Any payment on a single day to a particular person in excess of 10,000 otherwise than by approved modes will normally be disallowed. However, Rule 6DD has exceptions where an employee is temporarily posted outside base location. Payment can be made by unapproved modes. So in this case, there is nothing to disallow because it is covered under an exception to the rule of 48(3). This is covered under an exception to the rule of section 48(3), where employee is temporarily posted outside the base location. You can still claim it. Okay, outside the base location, you can still claim it. The company has taken up initiative to restructure its debt and paid 20,000 as prepayment premium allowed. Okay, prepayment premium Okay, allowed. Nothing is there. It is a proper business expenditure. It is a proper business expenditure. So it should be allowed. It's a genuine business expenditure allowed. Okay, repayment premium. Okay, and 50,000 loan waived directly taken to its reserve account. Waiver of term loan. Okay, I am assuming it as term loan. Okay, no adjustment to P&L. Waiver of term loan. We will not have an adjustment to P&L because it has nothing to do with income. Suppose if you have assumed it as working capital loan, you would have added 50,000. Suppose you can have that assumption. I completely agree with you. Okay, I have written it as term loan. You can have an alternative assumption, but it is a working capital loan, in which case it should be treated as income. It should be treated as income. The company contributed 50,000 to an electoral trust. Okay, contribution to electoral trust. 50,000. Contribution to an electoral trust, 50,000 added back. Okay. Okay. However, 80 GGB can be claimed. You write this note and leave it. 80 GGB, that is donation to political party, because electoral trust indirectly benefits the political party, that can be claimed. Next. Scientific research expenditure allowed. Okay, they have not debited it. They have company are invested in approval, etc. And the same is considered as asset in the books. Same is so it is allowed actually. Okay, right. Equipment cost is 18 lakhs. Equipment cost, okay, 18 lakhs. Land not allowed as deduction. We all know. Please write it in examination also. Building is again allowed 11 lakhs. So, so this 29 lakhs, you can claim it as deduction. This 29 lakhs, you can claim it as deduction. Scientific research expenditure can be claimed as deduction. Okay, fine. The last is allowable depreciation. Okay, allowable depreciation. We have already kept it ready. Okay, right. Gross business income. Interesting question. Lot of adjustment. Detailed notes. Okay. State the obvious in examination. State the obvious. Okay. Next two questions are not examination questions. It is my own questions, but I want us to work because it will give you a lot of ideas about holistic thing. I'm not saying these are examination questions, but it is to generally get our knowledge clearly. Question number 4. Rajaboga Yoga Limited commenced a hospital with 200 patient beds in Kanchipuram, which qualifies for 35 AD. The company gives you the following: expenditure during 1920, construction cost, equipment cost, amount paid towards merging the practice, goodwill, other expenses to be capitalized with the cost of the building. Expenditure incurred in 2021. Construction cost, equipment cost 14 lakhs. 2 lakhs was paid on a single day as the supplier demanded the same in cash. Furniture 7 lakhs. Donation of rupees 2 lakhs was received for purchase, which was taken by the entity as capital fund. Revenue detail, income, regular expenses, depreciation as per books. Following further details are available regarding regular expenses. Payment made to a doctor without deducting tax at source. Payment made to a foreign consultant assisting in establishment, tax not deducted. However, the consultant submitted sufficient proof in July 21 that he has considered the same as income and paid the tax. Payment made by cash on 10 different dates for expediting approval and secret commission. Determine the income. Working note for expenditure under section 35 AD. Working note for expenditure under section 35 AD. Always, wherever we want to consolidate, do it as a working note, consolidate, so that in the main answer we are presenting it simple, straightforward for the examiner. Okay, right? Expenses of incurred before 1/4/20, that is before this year. Okay, cost of construction 66 lakhs. Cost of construction 66 lakhs. Equipment purchased 11 lakhs. Goodwill for merger not allowed. Goodwill for merger, it is not allowed. Further, such goodwill is also not available for depreciation. I told you the amendment, you cannot claim. Okay. Other capital expenses 8 lakhs. Other capital expenses 8 lakhs. Expenses incurred during 2021. Expenses incurred during 2021. Construction cost 33 lakhs. Equipment cost 14 lakhs, of which equipment cost where on a single day for a particular person, if payment in excess of rupees 10,000 is made by unapproved modes, then the same will not be considered as asset value. On a single day, for a particular person, if payment in excess of 10,000 is made by unapproved modes, then the same will not be considered. In our case, 14 lakhs minus 2 lakhs. Okay. So 12 lakhs will not be considered, 12 lakhs will only be considered. That 2 lakhs will not be considered as asset value. You cannot claim depreciation, you cannot claim expenditure. Do not do it in unapproved modes. If you do it, I will not. Okay. Furniture and fixtures. According to Section 28 and ICDS, any subsidy for a depreciable asset should be adjusted with the cost of the asset. Okay, because somebody else has funded for some money, so that is nothing but subsidy. You are not paying for it. What are you paying for the asset? Okay, so 7 lakhs donation of 2 lakhs was received for purchase and is taken as capital fund. No, it should be adjusted with the cost of the asset. Subsidy standard ICDS and section 28 itself says, if it is for a non-depreciable asset or general subsidy income, if it is for a depreciable asset, furniture, fixtures and all depreciable asset, adjusted with the cost of the asset, do not take the subsidy as income and all or capital receipt and all. Okay. Working note for allowable expenditure. Working note for, because they have set some regular expenses and we will do a small working note for. Working note for allowable expenditure. Regular expenditure is 17. Okay. Regular expenditure is nothing but 17 crore 10 lakhs. 17 crore 10 lakhs. Less. Payment made without deducting taxes. Source. 30% of payment made to doctor as tax has not been deducted at source. So I will not allow the entire 3,80,000 which is there in that 17 lakh 10,000. I will disallow 1 lakh for that. I am not taking the profit to add it back. I am taking the expenditure. I am reducing the items which are so that the net claimable expenditure I will get. Repeating, I am not taking the profit and adding back disallow. I am saying what is the allowable expenditure. So I take the total expenditure incurred and reduce that which is not allowable so that I will get the allowable expenditure. 30% to a doctor, 100% to a consultant, non-resident consultant, non-resident consultant. Okay. However, the same is allowed in the financial year 21-22 as the consultant has submitted proof in that year. Okay, this is for you, not for the examiner. Remember, it will be first disallowed and allowed in the year in which proof is submitted. You have to remember this point. It is first disallowed and allowed in the year in which proof is submitted. So this year, certainly that 5 lakhs is disallowed. Next year, you have submitted the proof even in April 21. Also, it is allowed only in 21-22. Okay, just because you have submitted the proof within due date, I cannot allow it in the financial year of incurrence of 2021 itself. It is first disallowed. Okay, because you have not deducted tax. Next year, the default is rectified by he paying the tax. So next year only it should be allowed. Payment in violation of 40A subsection 3. Payment in violation of 40A subsection 3. Okay, I'm not writing detailedly 10,000 etc. You all know. Remember, secret commission, okay, takes the character of illegal payment. You can use the same words. Secret commission is something like illegal payment and it should not be allowed. It should not be allowed. So, total allowable expenditure. Total allowable expenditure. I'm not taking the profit to add back. I have taken the expenditure only to this extent I can allow it. Computation of income. Computation of income. What is the total income? 21.64 crores. Okay. Gross income 21 lakh 64,000. Sorry, 21 crore 64 lakhs. 21 crore 64 lakhs. Yes, allowable expenditure, okay, is 1691. You cannot take the book depreciation and all. Okay, expenditure under 35 AD. Expenditure under 35 AD. Okay, net business income. Net business income 3 crore 30 lakh 9,000. 3 crore 30 lakh 9,000. Had it been a loss, I would have categorized it as a loss from specified business. Okay, okay, my dear friends, shall I go to the next question, which, as I told you, is one of the questions which has been drafted keeping in mind the disallowance provision. Okay, so it is not again an examination question, but understanding disallowance will be the best part of this question. So, irrespective of the examination importance, try to understand it fully so that we complete this chapter at the preliminary level. This chapter is going to continue all throughout at the preliminary level with this wonderful question. Following particulars are provided for 3 consecutive years for a non-manufacturing entity. Net profit before, okay, so we have to reduce the expenditure before the following items. Payment made to a non-resident without deducting tax at source. Non-resident was able to provide sufficient proof and declaring the same as income and paying the tax in the respective year. Payment to resident assessee without deducting tax at source. Rectification of the above payment. Payment to a director without deducting tax at source. Director submitted proof of declaring the same as income in his return. Director sitting fees without deducting tax at source. Payment to a non-resident outside India, and the said payment cannot be regarded as income in India. Employer contribution to PF paid exactly on the due date of filing return. Employee contribution paid so. Interest on term loan paid after due date. Provision for gratuity, actual gratuity paid. Payment made to a resident transport operator on a single day. Payment made to a purchaser directly from growers of coffee on a single day. Waiver of term loan by bank for machinery purchased in the past year. Waiver of interest on such term loan. Waiver of working capital loan. Depreciation details, opening WDV, additions in less than 180 days of plant and machinery 15%, depreciation for all other assets. Read the question once, we will work out together. We'll work out. I'll make you understand each point so that this can be in any 1 year, how the adjustment takes place in that next year. Opening WDV 21,40,000. Additions less than 180 days, less than 180 days, 17,40,000. Deletions in this year, nothing. Balance available for depreciation. Okay, less depreciation. Please understand, 17 lakh 40,000 into 7.5%. 17 lakh 40,000 into 7.5%. Okay. 38 lakh 80,000 minus 17 lakh 40,000 into 15%. Okay, 17 lakh 40,000 only normal depreciation. It's not a manufacturing entity, so no additional depreciation, only normal depreciation. 17 lakh 40,000 into 7.5% plus 21 lakh 40,000 into 15%. That 2140 you should not put it directly. 3880 minus 1740. Okay, closing WDV. Okay, depreciation for other assets. Depreciation for other assets 3 lakh 10,000. Okay, 310, 272, 311, 2 lakh 72,000, 3 lakh 11,000. Okay, total allowable depreciation. Okay, nothing but in this year, this plus this. Okay, okay, please wait and complete it. Okay, in the next year, the closing WDV becomes the opening WDV. The closing WDV becomes the opening WDV. Less than 180 days, 11 lakh 80,000. 11 lakh 80,000. And remember, in this case, term loan waiver as per Steel Authority of India case law. The term loan waiver, okay, waiver of term loan for machinery purchase 1,40,000. Whenever there is a term loan waiver, okay, whenever there is a term loan waiver, it should be adjusted. Whenever there is a term loan waiver, it should be adjusted. So 1 lakh, remember that point, term loan waiver, which is directly for an asset, it should be adjusted with the cost of the asset. So, or the book value of the asset. So this 140 will be reduced. Now it will be 11 lakh 80,000 into 7.5%. 44 68 500 minus 11 lakh 80,000 into 15%. Repeating, 11 lakh 80,000 into 7.5% plus 44 68 minus 11, somewhere around 3288 into 15%. Okay, okay. So please understand depreciation. The second year is important to understand, and it is not a manufacturing, so no additional depreciation or all is not there. So the waiver of term loan, whenever you read that, please remember it should be adjusted with the cost of the asset. Quote the case law if you remember. Okay, by doing it in the classroom repeatedly, we try to remember the case law. Computation of income. Computation of income. My dear friends, it is going to be interesting to compute. It is going to give you lot of knowledge. I want you to understand every line of it. Net profit before making the adjustment. So it is not after, it is before making the adjustments. Okay, okay. Net profit before making the 23,40,000, 21,19, 34,14. Okay, less allowable expenditures. Okay, it is before. So I need to give I need to allow whatever expenditures in the respective years are allowed, we need to. Okay, so this is the net profit less allowable expenditure. Payment to a non-resident without deducting tax at source. Non-resident submits proof. Okay, payment to NR without deducting tax at source. NR submitting proof will be allowed only in the year in which proof is obtained. So, for the first year payment of 76,000, he would have submitted proof only in 2021. This 84,000, because after the year end is after the year is over only he can submit his income tax return. So this 76,000 can be claimed only here, and this 84,000 can be claimed only here. 76,000 can be claimed only in the second year, because he can submit the proof only after the year is over. So 7 minus 76 minus 84 in the subsequent year. In the subsequent years. Okay. Okay. So year of submitting proof only you can claim. Payment to a resident assessee without deducting tax at source, rectification adjusted. So with regard to resident assessee, please understand, all of us in the classroom, please understand, only 70% will be allowed. 30% in the year in which you are rectifying the default. Once more, only 70% will be allowed, 30% only in the year of rectifying the default. Payment to a resident without deducting tax at source. Only 70% will be allowed. So what happens here? 1,24,000 into 70%. Similarly, 1,40,000 into 70%. 1,24,000 and 1,40,000 into 70% will only be allowed. Okay, 30% allowed in the year of rectification. 30% allowed in the year of rectification. 64,000 into 30%, 2 lakhs into 30%. So it will be allowed in the year of rectification. Okay, right. Salary paid to a director without deducting tax at source. Director can only submit the proof in the subsequent year. Okay, salary to a director without deducting tax at source, only 70% is allowed. So what happens? 12 lakhs into 70%, 12 lakhs into 70%, 14 lakhs into 70%. 12 lakhs, 12 lakhs, 14 lakhs into 70%. Okay. 30% allowed in the year in which director submits proof of considering it as income and filing returns. So in this year, the remaining 12 lakhs into 30%. In this year, 12 lakhs into 30%. Similarly, here also 12 lakhs into 30%. He has submitted proof only in the subsequent year. So whatever I disallowed in the preceding year will be allowed in the subsequent year, will be allowed in the subsequent year. Okay. 70% of directors' sitting fees as taxes not deducted at source. According to 194J, there is no threshold for this. Yeah, okay, there is no the 30,000, normally 194J. We will see it there also. But in this case, the 30,000 is not there. So 18, 22 and default is rectified. So here it is 18,000 into 70%. Here it is 22,000 into 70%. Okay. 30%, then default of the above is rectified. So 18,000 plus 22,000 into 30%. Okay, repeating 18,000 plus 22,000. Those are all the two expenditure into 30%. I would have disallowed in the first 2 years, or I would have allowed only 70%. The balance 30% in the year in which the default is rectified. In the year in which the default is rectified. So I am allowing it. Payment to a non-resident outside India, and the payment cannot be regarded as okay. I am giving you two case laws, Maruti Suzuki and Wiscraft International. Please remember these two case laws, or any one also fine. Okay. Any payment to a non-resident accruing outside India and paid outside India shall not be treated as income for such non-resident. Hence, hence TDS provisions are not applicable. Okay. When will TDS, when should I deduct tax for a non-resident? Only if the income accrues or arises from India, or it is received in India. Repeat along with me. For a non-resident, tax has to be deducted at source only when the income accrues or arises from India or received in India. If this is not there, neither accrues or arises from India nor received in India, it is not taxable for the non-resident. Even though the payer is a resident, it is not taxable for the non-resident. When it is not taxable for the non-resident, why should I deduct tax at source? Why should I deduct tax at source, sir? It is not taxable for that non-resident. So there is no requirement to deduct tax at source. There is no requirement to deduct tax at source. Not sure whether I don't. Here is the no. This is not the case law. This is assessment procedure case law. I think I missed to record that case law. Okay, but the case law specifies where income is not considered. When it is not an income for the non-resident, there is no liability to deduct tax. Income accrues or arises to the non-resident outside India, received outside India. The payer might be the Indian company, but still it is not taxable in India. So there is no default as such. There is no default as such. You can allow it in the respective years. Both Viscraft International and Maruti Suzuki has the same judgment. Any payment to a non-resident accruing outside India and received outside India, it will not be treated as income. So no TDS. Just because you have not deducted TDS, don't disallow it. It is allowed. Employer contribution paid as per due date of IT law. Actually, when I drafted this question, the due date and the payment date were the same. Now we can even take it as 1 month prior to the date of filing the returns. Okay, actually, when I drafted this question, it was so. Okay, 70, 78, 80. 70, 78, 80. When I drafted this question, it was so. Okay, right. So I did not change it as 1 month prior employer because my intention was different. Employee's contribution paid after the due date of PF law shall be treated as income. Employee's contribution we saw in section 41 paid after the due date shall be treated as income. Subsequent payment will not be allowed as deduction. So in this case, employees contribution, this will be treated as income. 64,000, 70,000 and 70,000. These will be not a reduction but directly an income. Okay, paid after the due date under PF law will be treated as income, Remember, it will be treated as income and the subsequent payment will also not be allowed. Employees contribution, you are supposed to pay it on the relevant date. Interest on term loan paid after due date. Interest paid after due date. Okay. Disallowed under 43B and allowed in the year in which it is actually paid. So you cannot claim it in the first year. Whatever is the payment, next 2 years only you can claim because though it is accounted in the year 1920, 2021, but claim can only be in 2021 and 21-22 because you have not paid within due date. Statutory due. Interest is a statutory due. You cannot claim it. Okay. Provision for gratuity never allowed. Not allowed. Okay. So remember, nothing of the contingent. 40A subsection 7. Okay. Section 40A subsection 7. It is not allowed as deduction. It is not allowed as deduction. Okay. Actual payment of gratuity is allowed. Okay. Actual payment of gratuity 54, 111, 116. 54,000, 1,11,000, 1,16,000. Okay. It is not attracted by 43B and all. You can pay it. You can pay it. Only payment to a statutory fund will be covered there. Okay. Don't worry about actual gratuity payment. 48 violation. Okay, for a resident transport operator, the limit is rupees 35,000 instead of rupees 10,000. Okay, so in the first year, I cannot claim it. I cannot claim it. Whereas in the third year, I can claim it because it is within 35,000. For a resident transport operator, the limit is not 10,000, it is 35,000. So this 27,000 can be claimed. 27,000 can be claimed. (48) violation. However, as per Rule 6DD, payment to agriculturist is an exception. So coffee is an agricultural commodity. We all know, partly agriculture, partly business. So even though you have paid it in cash on a single day, these two things are allowed. These two things are allowed because it is coming under an exception clause. You can pay it. You can pay it by cash. Okay. Okay. It is not an examination question. I am trying to recollect lot of provisions about disallowance so that we are very clear about in 1 year they will give you, which adjustment to make. Waiver of term loan, already we have considered. Waiver of interest, no adjustment. Waiver of interest, no adjustment because it would have been already disallowed. It would have been already disallowed. Now waiver will not be treated as income. Waiver of working capital loan to be treated as income under section 41. Why? Any waiver of working capital loan, okay, trading liability will be treated as income. So don't put it as minus. It will be treated as income. Allowable depreciation, we have already computed and kept it ready. Allowable depreciation, okay. Total income after all adjustments. Total income after all adjustments. So this is a nice question to understand. That's why I always kept this question waiting on that day. I don't want to do it to you in that tiredness, so that you will be able to understand and appreciate. Friends, we complete the discussion on standalone chapter of PGBP. I'm not saying we completed PGBP. We complete the discussion on standalone chapter of PGBP here. Okay, this is just as a standalone chapter. We will continue to do PGBP in various other chapters, so that once more we will recollect all this provision and be very strong in this particular chapter, if this is the chapter which is challenging you. Okay, we have covered the theoretical, we have covered the case laws, we have covered the practical understanding how the adjustment is. we saw the amendment of PGBP is majorly 44AB. The amendment is majorly 44AB, that 5% aspect. Otherwise, the amendments are not for financial year 20, but 5 years back itself, they said all these weighted deductions is going to go off. 150% is going to become 100% only. Okay, so what we read itself is only 100%, so you don't take it as an amendment. If at all you have read in the old provision, I request you to watch our amendment lectures so that you will become more clear. Okay, there I have given you whatever is the change in that material. Also, I have given you whatever is the change. With this, I enter the next standalone chapter. Okay, capital gains is definitely a standalone chapter by all standards. Okay, it will be a standalone chapter by all standards. Okay, rarely it will be clubbed and asked. Otherwise, as a standalone chapter only, the questions will be given. As a standalone chapter only, the questions will be given to you. Okay, fine. Let's understand capital gains. How we are going to approach this chapter in this fast track. We are first going to understand theoretically this chapter. We are first going to understand the entire theory of this chapter and then go and work practical solutions. At the beginning, we are understanding this chapter theoretically. At the end, we will work out practical solutions. The advantage is when we are working out practical solution, we will again recollect the theory, refer to the theory or recollect the theory. In that manner, we will be better off. Well, as far as possible, I have condensed this chapter from the examination perspective, from the past experience and generally on the importance. I have condensed this chapter from the examination perspective to a smaller level. A part of this chapter with regard to non-residents, we have already covered in our international taxation. What is that? They can compute the capital gains in the currency of their investment. Section 48, subsection 1. They can compute the capital gains in the same foreign currency in which they invested. So how to reconvert by applying TT buying rate, TT selling rate, and how to again compute in terms of INR, we have already checked in international taxation, non-resident taxation, where they will not get the benefit of indexation. They will not get the benefit of indexation. Okay, so our aspect now is to leave and cover the other things. What is this chapter all about? This chapter, my dear friends, is all about capital transactions and its taxation. Okay, it is a rare chapter. That is why they use the word gain and not profit. Profit means regular, whereas gain is isolated. That's why the chapter heading uses the word gain, because it is of rare nature. Okay, these type of, other than sale of shares and securities, which can be often, everything else, how many times a person will sell land, building, jewelry, all these things in a span of 30 years of his tax paying years. Even I take, he starts paying tax from 25, age of 25, and goes up to 55 or 60 in this 35 dynamic tax paying years. Others years are passive taxpayer. Okay, in this dynamic tax paying, twice or thrice only maximum he would have hit this chapter. Okay, so that's why this chapter is a rarity, but it is giving a good revenue considering the population, considering that twice or thrice into the population, it gives a good revenue. So what is the baseline of this chapter? You should have transferred a capital asset. Repeating, assessee should have transferred a capital asset. This chapter is applicable if assessee has transferred a capital asset. So we should understand what is capital asset and then understand what is transfer. In both the cases, in both the understanding, in both the definitions, elimination is more important than inclusion. Be it capital asset, be it transfer, what we need to understand is what is not a capital asset, what is not a transfer. Shall I repeat again? Elimination is more important than inclusion. What is not a capital asset is more important than what is capital asset. What is not a transfer is more important than what is transfer. Elimination is more important than inclusion. Okay, so in that manner, we will see elimination in a grandeur manner so that inclusion becomes simpler. First, what is a capital asset? Any type of property, whether you are using it for business purposes or domestic purposes, will be capital asset. Any type of property, be it business purpose or domestic purpose, is a capital asset. However, it will not include stock in trade, which is taxable only in PGBP, movable personal asset. Okay, personal asset which will not include immovable, archaeological collection, jewelry, drawing, painting. So, movable personal assets other than jewelry, drawing, painting, etc. will be treated as capital, will not be treated as capital asset. Movable personal asset. Rural agricultural land is not a capital asset. Gold bonds, special bearer bonds are not capital assets. So the exclusion is very important. Okay, the exclusion is very important. If you ask me what is a capital asset, can I directly define to you? Yes, I can define to you. All business assets or capital assets. All business assets. It can be furniture, fixtures, intangible, plant and machinery, anything. All business assets. Land and building, okay, is a capital asset. Jewel is a capital asset. Shares is a capital asset. Okay, shares is a capital. Shares and securities are capital asset. Painting, work of art, architecture, or capital asset. Okay, or capital asset. These are only capital assets. Okay, this is for business. This is all for others. Okay, this is only is capital asset and nothing else. In this land and building also, rural will not be taken. Only urban. Okay, only urban. Okay, these are only capital assets. So the exclusion is more. Exclusion is more. Suppose if it is a business asset, okay, I will give you an example. Car used for personal purposes is not a capital asset. Car used for personal purposes is not a capital asset at all because it is not falling in any of these things. Movable personal assets are not capital asset, domestic asset. But car used for business purposes is a capital asset. If that block goes off, there will be capital gains. Furniture used for personal purposes is not a capital asset, whereas business furniture is a capital asset. Okay, so all business assets are capital assets. With regard to domestic assets, movable domestic assets, only three things: jewels, shares, work of art, architecture, and painting. These are only capital assets. So elimination is lot, inclusion is smaller. What is transfer? What do you call it as transfer? You know, income tax law everywhere uses the term only transfer, not sale. Sale is very rarely used. Transfer is the most dynamic word we use in capital gains and everywhere. Transfer of asset on succession of business. Succession means amalgamation, demerger, conversions. The transferee will record the value of the assets prevailing as prevailing in the books of transferor. So, please understand the terminology transfer is only popular, not sale, because sale is a smaller term, transfer is a larger term. Sale is a smaller term, whereas transfer means or includes sale. One part of transfer is only sales. Exchange. I give an asset, in exchange you give me another asset. I give you machinery, you give me your company's shares. Relinquishment, taking away a right, giving up a right is also transfer. Destroyal is transfer, extinguishment of an asset. If I transfer my asset into stock in trade, conversion is a transfer. Transfer need not be a voluntary act. Even government compulsorily taking over my land and building is transfer. Redemptions are transfers. Partial possession is transfer, and member of a cooperative process society transferring is a transfer. So transfer is elaborate in our law. Sale, exchange, relinquishment, extinguishment, compulsory acquisition, conversion of asset into stock in trade, redemptions, partial possession, that is transfer of properties act. Through a power of attorney you take over a property, and a member of cooperative society. Everything is treated as transfer. Everything is treated as transfer. That leads us to a discussion of, important discussion of, what is not a transfer. Okay, what is not as a transfer? What is not regarded? As I told you, elimination is important. Here Based upon activity, I have split and given you so that it will be easy for you. Based upon activity, I have split and given you so that it will be simple for you to, okay. Closure of business. You all know what are all the types of entity. Sole proprietorship, partnership, and LLP is part of it. HUF, company. You know, for a company and HUF, only this transaction is not regarded. Transfer of capital asset at the time of partition of HUF is not taxable. At the time of liquidation of a company, it is not taxable. But it is taxable in the hands of the shareholder, that we will come to it, okay? But in the hands of the company, it is not taxable. I want the class to understand dissolution of a firm is taxable in the hands of the firm. We will work out solution, but the question is going to be only for May 22 when you all become a chartered accountant, because new section 9B has been introduced in the law for the next year. Okay, whenever after becoming chartered accountant, you watch my May amendment lectures, I will talk about it, why that section was introduced, etc. Okay, but let me not now deviate. Okay, dissolution of a firm is taxable in the hands of the firm. If a trust dissolves, we are going to see something known as exit tax. Whereas liquidation of a company is not taxable in the hands of the company, is taxable in the hands of the member, because he is giving his share and getting the money. We will see. And partition of HUF is not taxable. Actually, by law, not only here, in house property, everywhere, member transferring to HUF transferring to member, not transfer, income will be taxable in the hands of transfer or only. Income will be taxable in the hands of transfer or only. So that is one side. Gift is not taxable. Gift is not taxable. Inheritance are not taxable. Conversion of bonds into shares, debentures into shares, preference shares into shares are not taxable. Are not taxable. When you resell that transferred instrument as shares, the cost of acquisition will be cost of debentures, cost of preference shares, cost of bonds, whatever it is. So I am not taxing it at the time of conversion. I am waiting for you to sell that shares. I am waiting for you to sell that shares. At that time I will tax it. We all know none of the succession is taxable. Amalgamation, demerger, conversion of company into a LLP, LLP into company, firm into company, none of this is taxable. And also transfer of 100% holding company to 100% subsidiary company. Holding company to 100% subsidiary company or vice versa are not taxable. Are not taxable. Or okay, are not taxable. Even this provision is for a foreign company. Why? I will give you an example. A foreign company holds shares in an Indian company. Can I repeat? Foreign company holds shares in an Indian company. That foreign company amalgamates with another foreign company. This foreign company amalgamates with another foreign company. You know, it is not taxable. It is not taxable. One foreign company amalgamating with another foreign company, it is not taxable, even though they have Indian company shares. Though they are transferring it, it is not taxable. One law always makes it, even in non-resident, this foreign citizens, etc. we saw. It should not be taxable in your country also. In our country, amalgamations are not taxable. So in that country also, it should not be taxable. Otherwise, I will tax it. Otherwise, I will tax it. Please read this 9 points once. What about Vodafone case? I think I explained it to the class about Vodafone case. Substantial value it should derive from assets in India. Then that shares sold is different from amalgamation. That is, the company itself is sold, not amalgamated. That is a different thing. What I now spoke is a different thing, Ajay. Okay. So imagine a circumstance X Limited and transferor company amalgamated with Y Limited. Okay. And all the assets of X Limited are taken over at Y Limited only at book values. We already saw. So it is not treated as transfer, no capital gain. I am a shareholder of X Limited. I am a shareholder of X Limited. Y Limited allots me shares because X Limited has amalgamated with Y Limited. What I do, I surrender the shares of X Limited, gets the shares of Y Limited. I surrender the shares of X Limited, gets the shares of Y Limited. That is also not transfer. Even though there is an exchange that has taken place, allotment of shares by transferee company to the member of transferor company in a scheme of amalgamation is not regarded as transfer, same way demerger. For non-residents, also it is not regarded, this amalgamation etc. are not regarded. These has some conditions. These has some conditions. Firm into a company, unlimited company or private limited company into LLP. Like how many years, who should, they should continue. I will cover this condition in assessment of firm. I will cover this condition. Don't worry that, don't think I have missed it. I will cover this condition exclusively in assessment of firm. I am not missing it. Okay, I know if there are conditions and those conditions will be covered by me in assessment of firm chapter. Okay. Okay. So transfer, two things we have to understand. Capital asset, not a capital elimination method. Transfer also elimination. Now I will talk from examination perspective. Okay. All these successions will be very simple. That is, it is not regarded as transfer. Transfer by holding company to subsidiary company or vice versa, provided the transferee is also an Indian company. Sometimes they say foreign holding company or foreign subsidiary, then tax it. Then tax it only if the receiver, the transferee, only if the receiver is an Indian entity, Indian company, it is not taxable. Amalgamation of banks, demerger, everything is a check whether it is an Indian entity. With regard to conversion, I have some conditions. I will come to that. Okay, right? Otherwise, I don't think transfer is being even tested. Gift or inheritance is not a transfer. We all know when we do the questions, we will again get it right. Okay, classification into short-term capital asset and long-term capital asset. First, I will tell you why should I classify. First, I will tell you what is the importance of classifying capital asset into short-term and long-term. Two reasons: mode of computation, rate of tax. Once more, why should I divide the asset into long-term and short-term? Two reasons because of which I divide. Mode of computation is different. A long-term capital asset is going to have something popularly known as indexation, whereas a short-term capital asset does not have indexation. Repeating, a long-term capital asset is going to have something in the name of indexation. Short-term capital asset does not have indexation. This is one reason. Long-term capital assets are covered under section 112 and it is going to be taxable at 20%, whereas short-term capital assets are taxable at normal slab rates. I'm not covering STT paid here, both for STCA and LTCA, that is separately taxed. But generally, for all other things, long-term capital assets are covered in section 112, where it is taxed at 20%, whereas short-term capital assets are taxable at normal slab rates. That is the reason for which I classify. One is mode of computation and second is period of holding. Rate of taxation. So I classify it on the basis of period of holding. Liquid assets. Main liquid assets. Anytime you can go and sell. Listed shares, units of equity oriented funds, okay, everything 12 months or less, it is known as short term. If it is not a short term, long term. So more than 12 months, long term. Not so liquid, unlisted shares and land and building, 24 months. Any other assets, rarely you will sell jewelry, rarely you will sell some other capital assets like debentures, debt funds, etc. 36 months or less is short term, more than that is long term. Repeating, most liquid assets of listed shares, listed securities, units of equity oriented funds, 12 months. Assets which are of popular nature, immovable property and unlisted shares, 24 months. Other assets, 36 months. Up to this period, short term. Beyond this period, it is known as a long-term capital asset. This period computation of holding, held held for. Normally the word held for means owned. The law will use the term held as a substitution for the term owned. Owned by the depreciation is available if the asset is owned by the assessee, held by the assessee. Held is a substitution term for the word owned. In some cases, the term held is to be understood with a broader sense. Gift, the first easy case to take, gift. I purchased the property in 2015. In 2019, I give the property to you, and in 2020, you sold the property. You transferred the property. Repeating. I purchased the property in 2015. In 2019, I gifted you the property. Gift is not a transfer. No capital gains for me. In 2020, you sell the property. Is it an STCA or LTCA? Why this confusion? You are holding it, owning it only for 1 year or less than that. I gifted it in 19, you sold it in 20. As a owner of the property, you are holding it only for 1 year or less than that. But the previous owner has only gifted you, which is not taxable. The previous owner has only gifted you, which is not taxable. At that time, I have not taxed it. So now the biggest question is, should I take the previous owner's period also as my ownership? The law says yes. The law says yes. The holding period of the previous owner will also be clubbed with yours. Very soon I am going to come to a case law called Manjula J. Shah, where they have given this importance. Okay, I'll come to that. Now you understand. Holding period of the previous owner will be clubbed with the holding period of yours. Holding period of the previous owner will be clubbed with the holding period of yours. In what circumstance? In gift, in inheritance, and all types of succession. In all types of succession, in gift, in inheritance, in all these cases, holding period of the previous owner will also be considered. So, to determine whether it is an STCA or LTCA, when it was originally purchased by the previous owner, that date to the date of sale. When it was originally purchased by the previous owner, that date to the date of sale, compare and see whether it is STCA, LTCA. Shall I again tell you? Gift. Where there is succession of asset. Gift, inheritance, conversion, amalgamation, demerger, holding subsidiary transactions, partition, where there is succession of an asset. The holding period of the previous owner will also be taken for classification. Once more, gift, inheritance, partition, amalgamation, demerger, holding subsidiary, In all these cases, the holding period of the previous owner will also be taken for determining the classification. For determining the classification. Okay, okay, okay. Very soon I will again repeat it. Read this. Okay, okay, hold it, hold it. When we do questions, I will again recollect for you these provisions. Okay, capital gains, our approach is different. PGBP read the provision, did the question, went to the next provision. Capital gains, read the provisions, then go to read the provisions fully, then go to questions. At that time, we will again recollect the provision so that it is nailed into us till our examinations are over. Okay, okay. I'm practically speaking. I'm very honest to you that if you think that whatever we are reading we are going to lifelong remember, I wish that might be true. But the honest fact is, after exam, if you are not in tax department, you will not be remembering all. These are for reference only. We'll talk about it later. Okay. I told you the purpose is two-way. The purpose is two-way for classification. One, mode of computation. Here is the mode of computation. For short-term capital asset, whatever is the sale value or full value of consideration, less cost of transfer, net consideration, less what is the purchase price, what is the improvement that happened, will give me gross short-term capital gain. Gross short-term capital gain in our answering sheet also. If it is green, it is STCG. If it is maroon, it is LTCG. In our Excel also, I am going to follow the same coloring pattern. Okay, STCG, go green. Okay, in the case of LTCA, long-term capital asset, full value of consideration, less cost of transfer, net consideration, up to this point same. Here it is indexed cost of acquisition, indexed cost of improvement. Indexed cost, indexation is a benefit which is available for LTCA, whereas it is not available for STCA. Can all LTCA avail it? No. Already we know non-residents who are going to compute in Forex cannot avail it. Some other things also cannot avail it. This is the broad format of our working. Okay, okay. I'm going to go into each and every terminology to make it clear to you. Okay, I'm going to go and explain to you each and every aspect of this entire working. If we understand, it's over. full value of consideration. What is this? Nothing but sale consideration. Nothing but sale consideration. But in all cases, is it sale consideration? The answer is no. Full value of consideration is normally the sale consideration, but in all cases, it is not so. In some cases, deemed consideration is taken. In some cases, deemed consideration is being taken. What are all the cases for which I will take deemed consideration? Let us look into it. If an asset is destroyed, I have not sold the asset. Fire gutted the asset. Natural disaster destroyed the asset. So what will be full value of consideration is insurance compensation received. Insurance compensation received will be treated as a full value of consideration. Compulsory acquisition. I have not sold the asset, but today morning when I opened the paper, I understand that the metro rail project is going on an expansion basis. All these survey numbers are acquired by the government through a notification, and one of the property is in that survey number, one of my property. Compulsorily taken over through a notification. Whatever government pays me as compensation is my full value of consideration. I have not sold, it is compulsorily acquired. Till it is transferred, whatever government gives me as consideration, I should take it. I started real estate business, use my own property. Conversion of asset into stock in trade, FMV on the date of conversion. Fair market value on the date of conversion will be treated as full value of consideration. Will be treated as full value of consideration. Partner introduces asset into the firm. Normally the entry is asset account debit to partner's capital account. Whatever is the value of the recorded in the books, I will take it. Whatever value is recorded in the books, I will take it. Whatever you are crediting to partner's capital account, whatever you are crediting, I will take it. Where a firm is dissolved, I told you just, liquidation is not treated as transfer. Partition is not treated as transfer, whereas dissolution of a firm is treated as transfer. Dissolution of a firm, fair market value, the most important on the date of distribution, not on the date of dissolution. When you give it to the partners, what is the fair market value? FMV on the date of distribution. Just now I said in the beginning also, liquidation of a company is not treated as transfer. Liquidation of a company is not treated as transfer, accepted. But for member, capital gain comes. For the member, because I am surrendering shares. capital gain arises. Distribution of assets to members on liquidation of a company, it is taxable in the hands of the members. I will work out questions and show you. Monetary consideration, FMV minus deemed dividend. You leave it to me. I will work out the question and then you will be able to understand it. If you are straight away catching the point also, fine. Monetary consideration plus FMV of the asset minus reserves is what is nothing but undistributed profit. If you give me back my reserves, that is not for the asset. It is my profit. So minus proportionate share of reserves. If you don't understand it here, don't worry, we will do questions on all these things so that you are very, very clear. Specified agreement. What is this specified agreement? I have a land, I give it to a builder who says he will construct house and allot me some houses. Joint development agreement between the assessee and builder, where assessee gives his land or building also, or land and building also, and gets allotted land and building along with areas, undivided share. Okay, I have a land, I find a builder who says he will develop it into an apartments, he will give me some apartments. This is known as specified agreement. Stamp value of area allotted plus any monetary consideration paid. Plus any monetary consideration paid. Transfer of immovable property. Transfer of immovable property. We all know section 50C says actual consideration or stamp value, whichever is higher. The amendment of this year, last year itself amendment came as 105%, now it is 110%. Where the stamp value does not exceed 110%, then actual consideration will be taken as full value of consideration. Where the stamp value does not exceed 110% of actual consideration. Does not exceed 110% of actual consideration, then actual consideration will be taken. So 10% tolerance. I told you in range concept itself. It has also peeped it into direct taxation also. 10% tolerance. Here we normally colloquially say here and there 10%. Okay, so that now law also allows. Unlisted shares section 50CA, actual consideration or fair market value of the shares on the date of transfer, whichever is higher. Whichever is higher. Normally, full value of consideration is sale consideration. Normally, full value of consideration is sale consideration. But in some cases, it is different. In some cases, it is different. Insurance compensation, if it is destroyal. Government compensation, if it is acquisition. Fair market value in the case of asset transferred, asset converted into stock in trade. Distribution of asset to partners. Distribution of asset to members. In all these cases, fair market value will be taken on the various date. Partner introducing capital, I will take the book value only. Specified agreement, I will take the stamp value. 50C, I will take the stamp value with 10% tolerance, and 50CA, I will take the fair market value again. Quick read through, but with an assurity that we will be redoing all solutions on this. At that time, I will make you remember the concept. Okay, right. Coming back to the format, full value of consideration less cost of transfer. Expenses at the time of transfer can be taken as cost of transfer. Net consideration, what is meant by cost of acquisition, what is meant by purchase price. At the time of purchase, whatever I pay, and if I incur any expenses at the time of purchase, whatever I pay, and if I incur any expenses at the time of purchase, that will also be forming part of cost of acquisition. Once more, at the time of purchase, whatever I pay plus expenses incurred at the time of purchase, everything will be treated as cost of acquisition. Are they deemed cost of acquisition? The answer is yes. I told you all successions. What are all successions in this chapter? Can we repeat? Gift, inheritance, amalgamation, demerger, holding subsidiary transaction, transfer of shares for getting shares allotted in amalgamation, for getting shares allotted in demerger. Okay? All succession, I told you to take the holding period of the previous owner. The cost is also of the previous owner. The cost is also of the previous owner. Cost of acquisition is also of the previous owner, because you don't pay anything. You got it free. So cost of the previous owner. But one problem is, though we are going to speak little later, indexation started from the year 2001-2. The base year for indexation is 2001-2. If an asset is purchased before 2001-2, before 1/4/2001, I can take as if the asset is purchased on 1/4/2001. Once more, if an asset is purchased before 1/4/2001, I don't have the base year, because base year for indexation is 1/2. So what I did is, I can take the fair market value as on 1/4/2001, because as if I purchased on that date. That is where our entire thing starts. If asset is acquired before 1/4/2001, either actual cost or fair market value as on 1/4/2001, whichever is higher, with an amendment, with an important amendment. FMV as on 1/4/2001 should not exceed the stamp value prevailing on that date. FMV as on 1/4/2001 should not exceed the stamp value prevailing on that date. It's an important amendment. In all these cases, cost of the previous owner. In all these cases, cost of the previous owner. Everything is cost of the previous owner. Debentures converted into shares, cost of debentures. Preference shares, cost of preference shares. Bonds, cost of bonds. Amalgamation, cost of the transferor company. Shares purchased in the value of for shares paid in the transferor company. Everything which comes under inheritance or succession will be the cost to the previous owner. Depreciable asset, we all know the block should go opening WDV plus addition. Slum sales, we will do solutions, net worth of the date of takeover. For shares, I will separately work out. Shares alone, when we are working out, we will come back and read. Shares alone, we are not reading it now. We will do it shares. I have written it here. Don't worry. But shares alone, we will do it separately. Cost of improvement is nothing but capital expenses incurred. And the difference between STCA and LTCA depends on the mode of computation. This word called indexation. This word called indexation, where I convert the rupee value to the current values. We all know what is indexation. Cost of inflationary index released by the government to give the what is known as net present value of rupee. Net present value of rupee. 100 rupees of 2001 is worth 301 rupees for 2001. That is known as government release. So that will be taking government inflation rates. So money value of changed. Okay, so indexation is a benefit which is available only for long-term capital asset, and that too not for all long-term capital asset. No benefit of indexation for short-term capital asset. Slum sales, debentures and bonds will not have indexation. Okay, non-residents will not have indexation. So friends, the mode of computation, the format which we understood, that is full value of consideration, less cost of transfer, cost of acquisition, cost of improvement, or indexed cost of acquisition, indexed cost of improvement. The terminology indexation is only for long-term capital asset, that too not for debentures, bonds, slum sales, non-residents, others only. So I'm going to consolidate whatever we studied in a different fashion. I'm going to consolidate whatever we studied in a different fashion now. Before that, let me start about indexation of cost of acquisition, which we call it as ICOA, indexed cost of acquisition. What is the format or what is the formula for this? Okay, cost of acquisition. Cost of acquisition will be cost of acquisition into CII of the year of transfer. The numerator is CII of the year of transfer, cost of inflationary index of the year of transfer, divided by CII of the year in which asset was first held by the assessee. COA, cost of acquisition, which can be actual cost or deemed cost, into CII of the year of transfer, divided by CII of the year in which asset was first held by the assessee, or 100. Sometimes it can also be 100. Because if the property is purchased before 1/4/2001, obviously there is no CII, so it should be 100. First, I will speak about the numerator. Okay. CII of the year of transfer. Normally, this is 301 because, okay, for our year 2021, it should be 301. Normally, it will be 301. But in all circumstances, is it 301? The answer is no. However, where the year of transfer and year of taxation are different in year of transfer, because we all know the formula CII of the year of transfer. Normally it is 301. Suppose a transaction is taxable in 2021, but transfer has already happened. Transfer has already happened. What are all the case? Extinguishment, compulsory acquisition, conversion of asset into stock in trade, specified agreement. In all these four cases, the numerator need not be 301. In all these four cases, the numerator need not be 301. It can ultimately be 301 if it is in the same year. But suppose the property got destroyed in 1920 or 1819, compensation is paid in 2021. The property already got destroyed in 1819, or 1920, but the compensation is paid in 2021. Year of compensation is taxable. Year of receipt of compensation only it is taxable, but for numerator I will take CAI of 1819 or 1920 as the case may be. So it will not be 301, it can be 289, 280, 272, anything in these four cases. Numerator might not be 301. I cannot say definitely it will not be. If it is in the same year, fine. But there is a possibility it is not 301. Specified agreement. I transferred the land and building in a joint development agreement. Transfer is over. But when it is taxable, when that other person allots me, completes and allots me the property. So in these four cases, numerator need not be 301. It can be a different value also. It need not be 301. Okay, okay, right? It need not be 301. Now, one other important thing, CII of the year in which asset was first held by assessee. Imagine a circumstance. Watson gives to Preeti. Okay, Watson gives to Preeti in the financial year 1819. Preeti sells it in financial year 2021. Watson has actually purchased it in 2009-10. Will I take 1819 CII value as denominator or 2009-10's value as denominator? Because look at the wordings of the law. CII of the year in which asset was first held by the assessee. Preeti is the assessee, not Watson. Preeti is the assessee. Watson gifted to Preeti, not taxable in the year of gift. Gift is not a transfer, not taxable to Watson. Preeti subsequently sells it. Who is the assessee? Preeti. CII of the year in which asset was first held by the assessee. Assessee is Preeti. When did she get the asset? Watson gifted the asset to Preeti in the year 2018-19. In the year 2018-19. So first held is 1890. Till that time Watson is the owner. Held means ownership. Till that time Watson is the owner. Preeti becomes the owner of the asset only from 1819. So CII of 1819 says law. Not only for gift, all successions. What are all? Amalgamation, demerger, holding company, subsidiary company, conversions, debentures converted into shares, everything. Wherever I take the cost of the previous owner, it is known as succession. For all these cases, the denominator will be asset is first held by the assessee. Asset is first held by the assessee. Another example shall I give? Ventures subscribed in 1112, converted as shares in 1920, shares sold in 2021, shares sold in 2021, shares sold in 2021. Okay, debentures subscribed in 1112, converted into 1920. So that is not transfer. Conversion of debentures into shares is not transfer. Subscribed in 1112, converted into 1920, converted. So now when I am selling the shares, should I take 1920 or 1112? Asset was first held. What is the asset sold? What is the asset sold? Shares. When did I hold the shares? Asset, that is shares, first held. That is 1920. Correct? I first held the shares in 1920. So CII of 1920 should only be taken. Then so all these things, the law said asset is first held by the assessee. Asset is first held by the assessee. Then came the popular case law of Manjula J. Shah. So whenever these type of things comes, Manjula J. Shah case came as a different level of understanding. In this case, the judgment is when cost of previous owner is considered. Gift. What is the cost of acquisition for Preeti? Cost of acquisition of Vatsan. What is the cost of shares? Cost paid to debentures. Is it a long-term capital asset or short-term capital asset? Date of purchase and date of sales by Preeti. The cost of previous owner is considered. When holding period of the previous owner is considered, indexation benefit of previous owner should also be provided. When the cost of acquisition of the previous owner is considered, when the holding period of the previous owner is considered for determining LTCA or STCA, it is mandatory that the indexation of the previous owner should be also considered. So after Manjula J. Shah, it became CII of 910. It became CII of 1112. Has the law been amended? No. The law is not yet amended. This is just a case law. This is just a case law. The law is not yet amended, my dear friends. This is just a case law. But it has a huge impact. Unfortunately, as students, we need to give two answers. Our CA Institute has not yet recognized this case law as final because it is not by Supreme Court, it is Mumbai High Court. It is by Mumbai High Court. So, so our CA Institute has not yet said that this is the final. Okay, so we need to give two answers. One going by law, another going by Manjula J. Shah. The principle is going by law divided by CII of the year in which asset was first held by the assessee. Going by Manjula Desha, if the cost of the previous owner is taken, if the holding period of the previous owner is taken, indexation benefit available to the previous owner should also be provided. So according to this, it will not be CIA of the year of first held by the C. CIA of the year of acquisition only should be taken and not anything else. So numerator changes 4 times. It may not be 301. Extinguishment, compulsory acquisition, conversion of stock in trade, asset into stock in trade, because it is taxable in the year, and specified agreement. Denominator changes in all successions. However, if we apply Manjula Desha, denominator will never change. Denomination is constant. We will work out some solutions and then come for exemption. We will work out some 10 questions. From the 11th question, we will speak about exemptions. Okay, but before that, let me complete some case laws. Let me complete some case laws also before going and working out what is our exemption, and then we'll end up the class with the amendment. Conversion of freehold, leasehold into freehold. So far it was a leasehold property. Now I converted into a freehold property. So far it will be leasehold. So from the year of conversion only it is my property. No. No. It is just cost of improvement what you have paid. You hold the property right from the date you got it as lease. ICDS. Vehicles are registered in my name. Finally, after the term, I pay a lump sum and get the vehicle. Conversion of leasehold into freehold. Right from the date of registration, it is deemed to be held by me. What I pay to get all the rights is only cost of improvement. Aditya Kumar Jajodia. This is only cost of improvement. Of course, indexation and all can be done for that if it is of a different year. Friends, whatever government gives me compensation in compulsory acquisition is my compensation. If I am not happy with the compensation, I need to go to the court and contest it. You know that the battle will be long. Instead, I went to the government itself. I went to the collector and said, boss, I'm not satisfied. Let's negotiate and arrive at so that I need not again go to the court and all. So negotiation took place between the assessee and the government represented by collector. The assessing officer said, since the price is negotiated, I will not take it as compulsory acquisition. Compulsory acquisition means compensation paid by the government. You have negotiated that. So I will take it only as a sale, not as compulsory acquisition. Supreme Court said no. Negotiation is to avoid litigation. Negotiation is to avoid litigation. Just because you have negotiated, that doesn't change the characteristic. Land was acquired under Land Acquisition Act, and it takes the character of compulsory acquisition. Mere negotiation of compensation will not change its character, will not change its character. Like transfer pricing officer, there is a valuation officer also. To recollect, we said advance ruling agreements are not applicable if the question asked is fair market value of the property. Why? Because fair market value should be determined by valuation officer. Is AO bound by TPO's report? Yes. Is AO bound by VO's report? Yes. Valuation officer's report should be considered. It is mandatory for AO to consider VO's report and compute the capital gains. You cannot disregard or ignore the same we have studied in TPO also. Exemption based, I will come little later. Exemption based, I will come little later. Okay. This is also a recent case law, yet to be questioned, so please be ready for a question. Gujarat State Fertilizer and Chemicals Limited. What is this? Subsidy has to be provided to fertilizer manufacturers. Subsidy has to be provided to fertilizer manufacturer. Government does not have money. So instead of giving subsidy in the form of money, they gave it as bond. Transferable bond. The assessee transferred the bond, made money. Is it capital gains or PGPP? The court said, boss, this is PGPP. Why? Because it is given in lieu of subsidy. Had you given subsidy, where you would have accounted? ICDS and section 28 says general subsidies will be treated as income. Only subsidy for depreciable asset. General subsidies should be treated as income. They gave it in the form of bond. That bond was transferred by the assessee. So it should be treated as income. Fertilizers bonds are provided as part of subsidy. The government, instead of providing cash subsidy, it has provided fertilizer subsidy. Has cash subsidy been offered, it would have been treated as income. On the same lines, fertilizer subsidy should also be treated as income. That if there is a loss, it should be treated as business. Loss on sale of bond. Friends, I failed to put this in the material, the CII values, but I hope you can access it. In the examination, they are giving it. Okay, so if at all you have some material or something like that, where CII Institute material or anything, just have the CII page. Anyhow, I am going to show this and then only compute. Don't worry about it. question, lot of understandings ahead. Every question we will go back to the theory also and understand. Okay, so get prepared. House property belonging to an individual was completely destroyed due to fire on 11th April 2018, which means transfer has happened in the year 1890. Transfer has happened in the year 1819, 11th April 2018, because for these things, CII of the year of transfer, the numerator will be 1819. The said property was acquired in 78 for 4230. After all formalities, the insurance company paid a compensation of 5116 on 7th January 21. Compute capital gain. Full value of consideration, that is insurance compensation received. Okay, 51,60,000 less cost of transfer, nil, net consideration, 51,60,000 less ICOA, indexed cost of acquisition. The cost of acquisition is 42,30,000 into, okay, into 11th April 2018. 11th April 2018 falls in the year 1819, 280. 280 CII of year of destroyal, because that is transfer. That is transfer divided by CI divided by which year I acquired? 78. 78 happens to be 129. 129. Okay, 129 year of acquisition. Okay, okay, repeating, 42,30,000 into 280 divided by 129. Long-term capital loss, long-term capital loss, 40,21,395. 40,21,395. This is the loss of the financial year 2021, which can be carried forward. Why it is the loss of 2021? Okay, capital gain will be computed only in the year in which compensation is received. Even though the transfer has taken place already, capital gain will be computed only in the year in which compensation is received. In that year only the loss will be recorded, but the numerator will be year of transfer. The numerator will be year of transfer. Okay. Okay. Numerator, year of transfer, taxable only in the year in which compensation is received. Part B. If the property has been purchased by his father in 7/8 for the same value and the individual has inherited only in 15/16, how will your answer change? Here is where this Manjula Desha and law aspect comes. According to law, first held by the assessee. I got the property in 15/16, destroyed it. The property got destroyed in 1890. According to Manjula Desha, the father's date can be applicable. Look at how the working changes, all of us. Part 2. Okay, particulars. As per law, as per Manjula J. Shah. Okay, as per law, as per Manjula J. Shah judgment. Okay, both we will work in examination, give both answers. Very clearly, both answers we should give. As per Manjula J. Shah, the same answer will hold good, but let's see. As per law, first I am working out. Okay, 42,30,000, the same. 42,30,000 into 280 divided by 15/16. 15/16, 254. Okay, 254. Asset first held by assessee. Asset first held by assessee. So it will be 42,30,000 into 280 by 254 in the case as per law. Because law says asset first held by the assessee. Whereas Manjula Desha, the same will hold good. As per Manjula Desha, it will be year of acquisition by previous owner. Because the judgment says, when you consider, here also I consider 4230, I consider it as a long-term capital asset only, but denominator, so Manjula Desha judgment says, when you consider the previous owner's cost, previous owner's holding period, why are you not giving the previous owner's indexation? Provide the same. Long-term capital gain or loss. You can see the huge difference between these two. So, whenever you take the cost of the previous owner, all of us in the classroom, please remember, whenever you take the cost of the previous owner, work out two answers as per law, as per Manjula Desha. Don't write any conclusion. Just like Manjula Desha had a famous judgment like this. Part C. Interesting question. If the property is a business asset, not an individual's asset, and the opening WDV of the building was 21,40,000, this is the only building in the block, how will your answer change? Assume that the compensation has been determined and paid only in 2021. Can depreciation be claimed for 1819, 1920? The answer is yes. The answer is yes. Till you get the compensation, you can claim depreciation. Sir, can I ask you some questions? You said that the asset should be put to use. I am very clear. I have told you at that time also. You can recollect now and see. Only for additions the put to use condition comes, not for opening balance. Only for additions put to use condition comes. Otherwise, unless there is a deduction from the block, you can go on computing depreciation. Unless there is a deduction from the block, you can go on computing depreciation. So in this case also, for 1819, 1920, depreciation can be claimed. Okay. Question 1, number 1, part 3. If it is a business asset, if it is a business asset, okay, we all know that building depreciation rate is 10%. Opening WDV, 21,40,000. I asked you to remember few rates. Building, plant and machinery general, computers 40%, intangible 25%, car 15%. These 5 rates you remember more than that. Less depreciation for FY 1890, because this is opening WDV as on 1/4/18, as on 1/4/1821. Depreciation for 1819, this into 10%. Opening WDV as on 1/4/2019 is less depreciation for financial year 1920. Opening WDV as on 1/4/20. Less insurance compensation received. Less insurance compensation received, 51,60,000. 51,60,000. Okay. Whenever a depreciable asset is transferred and the block goes out of existence, the result is short-term capital gain, not short-term capital loss. In this case, short-term capital gain. Whenever it is short-term, we go green, so that our answer when you revise is very clear. Okay, so short-term capital gain 34,26,600. 34,26,600. Okay, whenever it's a depreciable asset, it is a short-term capital gain. Let us note down some of the point. Okay, till compensation is determined, depreciation can be computed. Even if the asset is not there, the block is there, depreciation should be computed. Once it is determined, the amount determined will be reduced from the block. In the year, compensation is received, it becomes taxable. So we all know that the short-term capital gain is for the year 2021. Is for the year 2021 only, the short-term capital gain, because that is the year I received compensation. That is the year I received compensation. So that is only for 2021. That is the beauty of this working. That is the beauty of this working. You can continue to claim depreciation till your compensation is finalized. Good question. We understood lot of things in one question. That's why I'm confident capital gains, whatever may be the question, you will be sweeping. Question number 2. Central government acquires the house property owned by Sham, which are on 10th October 2018. So the transfer is completed on 1819. The transfer is completed in the year 1819. House was purchased by Sham's father in 1997 for 75,000. Fair market value as on 1/4/2001 and the stamp duty. Gifted to Sham on 3rd September 2006. Sham spent improvement 140 and 3 lakhs. The government awarded 25 lakhs compensation, paid as 5 lakhs and the balance in April. Sham went on an appeal and the court increased the compensation to 1750. The said amount was received in April 22. Sham spent 75,000. Okay. Compute capital gains for various years. For the delay in paying the compensation, court has directed government to pay interest. How will this interest be dealt with? That's a separate answer. First, we'll do the first part, read it. Good question again. Full value of consideration, particulars as per law, as per Manjula J. Shah. Okay, right? Full value of consideration is 25 plus, okay, 25 lakhs. Yes. Cost of transfer, nothing is there. Net consideration, okay, fine. Yes, ICOA, indexed cost of acquisition. First, as per law, I am working it out. Cost of acquisition, property acquired before 1/4/2001. COA can be actual cost or FMV as on 1/4/2001, whichever is higher. Such FMV should not exceed stamp value as on 1/4/2001. Has it? FMV is only 1,56,000, stamp value 2 lakh. So FMV has not exceeded. If FMV has exceeded, I will take only stamp value. FMV should not exceed stamp value. In this case, not exceed. So I can take 1,56,000 into numerator year of compulsory acquisition October 10, 2018, 1819, October 10, 2018, 1819, which is nothing but 280, 280, okay, 280 year of compulsory acquisition divided by, as per law, whenever he inherited the property, 3rd September 2006, which happens to be 6/7, which happens to be 6/7, 122, 122, year of inheritance, year of inheritance. Whereas, as per Manjula J. Shah, it will be 1,56,000 into 280 year of compulsory acquisition divided by 100 base year. So, as per law, it will be 1,56,000 into 280 by 122, whereas as per Manjula J. Shah, it will be 1,56,000 into 280 by 100. Gross LPCG for financial year 2021 as compensation is received in that year, receiving even a part of compensation is sufficient. Okay, you received 5 lakhs in December 20, that itself is sufficient. Those things are not questioned, you don't worry. Okay, but I'm just under Manjula J. Shah, if it is after 1/4/2001, that year or base year. Whereas as per law, year in which asset is first held by the assessee, so year of inheritance. Two doubts. I will answer the second doubt. Sorry, I think I missed the cost of improvement. I missed to index cost of improvement. I stand corrected. I'm sorry. Okay, please. Yes, I indexed the cost of improvement. I did not. I forgot to. Two improvements are there. 1,40,000 in March 7 and 3 lakhs in, so 1,40,000 into 280 divided by, okay, March 2007, 67122. Okay, improvement formula will not change whether it is as per law or as per Manjula Desha. The next is 3 lakhs into 280 divided by March 14, so 13, 14, 13, 14, 220, 220. Sorry, I missed it out. 1,40,000 into 280 by 122, so 3 lakhs into 280 by 220. Regarding the other doubt, I'll come to it after answering this question. For additional compensation taxable in the year of receipt. So it is received in 21-22. There is no split like this directly. Additional compensation received. Additional compensation received 17,50,000 less legal charges. That is the only deduction allowed, 75,000. If this is gross LTCG, this is also for the same property only. This is also for the same property, gross LTCG. Okay. This is also for the same property, 16,75,000. Interest on delay in paying compensation. Interest on delay in paying compensation. Taxable under IFOS. This is taxable under IFOS. Section 56 speaks about it. Okay, section 56 speaks about it. Taxable under IFOS. Taxable only in the year of actual receipt of interest. It is not on accrual basis. It is only taxable in the year in which actually it is received according to section 57. 50% of such interest will be allowed as deduction. It's a flat deduction of 50% of such interest. It's a flat deduction of 50% of such interest. Very interesting again, though it is not in this chapter, but generally to have an idea. That's all. Again, a comprehensively understood compulsory acquisition question. one other question from our friend is with regard to this business asset. Sir, when the fire occurred, it is considered as transfer. When it is considered as transfer, I am no more the owner of the asset for claiming depreciation. Ownership is also a criteria. So our friend's question is, okay, can I still claim the depreciation? Is our friend's criteria. My answer is yes. According to income tax law, only block of asset method. Block ceases to exist only if I have a value here. Only if I have a value, my block will go out of existence. Till that time, even if the asset is not there, not used, I will continue to claim. Suppose a machinery is transferred to another person, one of the machinery in the block. There is still a value for that machinery in the block. There is still a value for that machinery in the block, because here we go only by block of asset concept, and that concept says unless something is received, the block does not cease to exist. So even a scrapped machine thrown off, you are no more the owner, you can still claim depreciation. So a comprehensively understood question. Okay. This is again about specified agreement. This is about specified agreement. Okay. One other question where I am making you understand a lot of things. Okay. Priyanka purchased the land in 1995. The fair market value is 1810, but whereas the stamp value is only 1750. Stamp value can only be taken according to the amendment of law, where the fair market value exceeds stamp value will only, the fair market value should not exceed stamp value. She handed over the physical possession of the property to a dealer on 15th August 2019. Transfer over for developing the land. The real estate dealer allotted her 40% of land area, one apartment, and monetary consideration of 15 lakhs. Completion was in December, on which date the stamp value of the whole land is 1 crore and apartment is 24 lakhs. What changes the computation will undergo if the completion and handing over is only in April 2021, other values remaining the same? If Priyanka sold her property in March 19 itself, what will be the capital gains? Read through. Oh, thank you. Specified agreement. Okay. Full value of consideration. The law says stamp value of land allotted The overall value of the land is 1 crore. 40% is allotted to Priyanka. Stamp value of land allotted 40 lakhs. Overall value of the land is 1 crore. 40% of the, if you read the question, you will understand. 40% of the land is allotted to Priyanka. Stamp value of building 24 lakhs. Monetary consideration 15 lakhs. Okay, so 79 lakhs. 79 lakhs. Okay, okay. In the case of specified agreement, joint development agreement between assessee and builder, where assessee gives land or building and gets allotted. Stamp value of area allotted plus monetary consideration. Priyanka purchased it. Okay, property was purchased before 1/4/2001. COA will be actual price, that is 11 lakhs, or FMV on 1/4/2001, which is 18 lakh 10,000, whichever is higher. However, according to the amended provision, FMV should not exceed, fair market value should not exceed, FMV should not exceed stamp value on 1/4/2001, which is nothing but 17 lakh 50,000. So 1750 will only prevail. So please understand, okay, actual cost, COA will be actual cost or FMV, whichever is higher. And according to the amended provision, that fair market value should not exceed stamp value. Where it exceeds, stamp value will only prevail. So what happens? Okay, 17 lakh 50,000 into year in which she handed over the property, 15th August 2019. 15th August 2019 becomes 1920, 289 into 289, year of handing over the property, divided by 100. Okay, 17 lakh 50,000 into 289 by 100. 289 by 100. Gross LTCG in financial year 2021, as the property was handed over in 2021, completed and handed over in 2021, it will be 28 lakh 42,500. 28 lakh 42,500. Repeating, gross LTCG in the year in which construction was completed. The law says stamp value taxable only in the year of completion and registration. Taxable only in the year of completion and registration, which was 2021. Part B. What if the property is completed and handed over in April 2021? The question is, what changes in the property was handed over only in April 2021? Computation will not undergo any change because the numerator I have taken only year of handing over, me handing over the property. Okay, so computation will not undergo any change. LTCG will be in the year 21-22 as the property construction was completed only then. Okay, to make it more clear, here of handing over the property by Priyanka. This is by the builder bank. If Priyanka had sold the property in March 19 for 60 lakhs, if Priyanka has sold the property in March 19 for 60 lakhs, law padikalama, okay, taxable only in the year of completion, however, where assessee sells before that in the year of sale. So what happens? Priyanka sells it in the year 1819 itself. Okay. Part C, where Priyanka sells the property in 1819. Okay, she does not wait for the completion. She sells the property in 1819. Okay, look how my working changes. Okay, nothing of this will come. Sale value of property under construction 60 lakhs. She has sold it for 60 lakhs. And she will receive from the builder monetary consideration 15 lakhs. Okay. Gross LTCG in 1819 as she has transferred the property before completion. Very rare, just have it. Very rare question, but have an idea. If at all there is a standalone question on specified agreement, this is how you need to approach it. This is the question I am waiting to explain you also. This is little liquidation of a company, repeating, liquidation of company and distribution of assets to members. Liquidation of company and distribution of assets to members. It is not taxable for the company. It is not taxable for the company. For the member, it is taxable. For the member, it is taxable. First, I will write something theoretically. Question number 4. Transfer of shares by a member on liquidation. Okay, that's what we are going to see. Distribution of asset to member on liquidation of a company is not a transfer for company, hence capital gain does not arise. For the company, it does not arise. For the company, it does not arise. Distribution of asset to whom? To members. For what? On liquidation of a company is not a transfer. Capital gain will not arise for the company. Capital gain will not arise for the company. Whereas for the member, it is taxable as he surrenders shares and gets consideration. For the member, it is taxable because the member is surrendering his shares and he is getting some consideration. Now I want the class to understand. Let us pursue. I am a 10% shareholder in a company which has gone into liquidation. What is meant by general reserve or reserves? Undistributed profit. In a year, the company earns a profit of 20 lakhs. The company has two options. Give it to the shareholders as dividend or retain it in the company itself. If it is given, it is dividend. If it is retained, it becomes reserves. But that is also my money. Profit of a proprietor belongs to the proprietor. Share of profit of the partners belong to the partners. Share of profit of a company belong to the shareholder. I am a 10% shareholder. On the date of liquidation, the company has 50 lakhs general reserve. The company has 50 lakhs general reserve. 10% of that 50 lakhs belongs to me. 10% of that 50 lakhs belongs to me. I am a shareholder. That is my profit, which you have not given it as dividend. Now give. So 10% of that profit belongs to me. So if you just give me 5 lakhs for surrender of shares, that means for shares you have not given me any money. Why? This 5 lakhs is my profit. What you have given me is my share of profit. Or what you have given me is my dividend. If you give me 7 lakhs, then I will accept. For 2 lakhs you have given for surrender of shares. Up to 5 lakhs it is my profit. And 2 lakhs you have given for surrender of shares. Okay? The law says distribution of asset to members on liquidation of a company. Monetary consideration plus FMV of the asset distributed minus proportionate share of reserves. That is not for shares. That is dividend for me. I already have 50 lakhs in the given example. 5 lakhs belong to me. You don't give me 5 lakhs and say this is for shares. No, this is my dividend, which on that day itself, if you have distributed, I would have got. You started accumulating. So, proportionate share of reserves will not be considered as for shares consideration. Where a member, whereas it is for a member, it is taxable as his under share. Okay. Consideration for shares will be over and above what he is supposed to receive as dividend. The consideration you are going to pay for shares is only whatever I am going to get over and above what I am supposed to get it as dividend. Okay, deemed dividend is proportionate share of reserves on date of dissolution. Up to that amount, it is only my dividend. Over and above that only will be considered as for shares. Mr. Raghu purchased 10,000 shares of a company in 2014 for 120. Company went into liquidation. The following is the financial position. 60,000 equity shares. Raghu holds 1/6. Raghu holds 1/6. General reserve 40 lakhs. 1/6 of this general reserve is my dividend. Don't tell me it is for shares. 1/6 is for my dividend. Agricultural land in urban area, cash in hand. The assets remaining after discharging this outstanding liability were distributed to the shareholder in proportion to their holding. The market value of the agricultural land is 60 lakhs. Agricultural land received by Raghu was further sold for 9 lakhs. Discuss tax implication dance of the company as well as Raghu. Read through. For company, I have already written, it is not a transfer, no capital gains. Computation of capital gains in the hands of Raghu. Full value of consideration. FMV of asset allotted. So the fair market value of land is 60 lakhs. 1/6 is Raghu's value. Okay, 60 lakhs. 1/6 belongs to Raghu. Monetary consideration. The company had a cash of 32,14,305. Outstanding liabilities is 814. The assets after the remaining discharge of outstanding liability were distributed to the shareholders. So 32,14,305 minus 814,305 divided by 6. Repeating, okay, 32,14,305 minus 814,305 divided by 6. Less proportionate share of reserves, which is nothing but deemed dividend. Proportionate share of reserves, which is nothing but deemed dividend, 40 lakhs. divided by 6, 40 lakhs divided by 6. So my net consideration is only this much. For the shares, I got only 7,33,333 because whatever you paid is 14 lakhs. Out of that, 6 lakhs is my dividend income and not for the shares I have surrendered. Yeah, answering that question. One lakh 20,000 into 301 year of transfer divided by, it is purchased in May 14, so 1415. So 1415, May 14, 1415, 240, 240 year of acquisition. Gross LTCG, gross LTCG, I'll write the note for the question asked by our friend also. Okay, now you will be more clear. Note, deemed dividend is taxable under IFRS. I'm not saying it is not at all taxable. I'm saying it is not considered as capital gains, that's all. So it will be taxable as IFRS, so that gross total income, assuming no other income, just say, will be, okay, these two things. I know the question is not yet over, but generally telling you. Okay, so yes, deemed dividend is taxable under IFRS, but it should be reduced from the consideration. That's what I mean. Till last year, the company would pay DTT for that. That's why the question always says, what is from the company? This year, no DTT, so fully taxable in the hands of the recipient, that is shareholder only. The agriculture land received above was transferred by Raghu for rupees 9 lakhs. Okay. Subsequent transfer of agri land. Full value of consideration 9 lakhs less cost of acquisition, because you have transferred it immediately. I'm not taking the cost of the previous owner. Okay, I'm not taking the cost of the previous owner. I'm taking your cost of acquisition only. Gross STCL, gross short-term capital gain 1 lakh. Gross short-term capital loss, sorry, gross short-term capital loss 1 lakh. Go green. Okay. Now, moving into the last part, moving into the last part of understanding cost of acquisition is with regard to shares. Especially with regard to listed shares. I want your understanding clearly focusing on it. Normally, cost of acquisition of shares is actual price including premium. Bonus shares allotted before 1/4/2001, I can take the fair market value. After 1/4/2001, I can only take nil. Bonus shares allotted before 1/4/2001, I can take the FMV as on 1/4/2001. Allotted after 1/4/2001, I can only take nil. Shares purchased from some other person, actual price paid plus any expenses. ESOP, shares employee stock option, if I get it like that. FMV on the date of exercising the option, because till that time it is in salaries chapter. So FMV on the date of exercising the option. Debentures, bonds, preference shares converted into shares, equity shares, cost of debentures. I want you to understand this part. This is for exclusively listed shares acquired on or before 31/1/2018. Acquired on or before 31/1/2018. Because till that date, LTCG on which STT is paid is not taxable, exempt under 1038. After this date, it became taxable. Okay, so understand, compare the sale value and fair market value as on 31 in 2018, determine whichever is less. Compare the sale value and the fair market value as on 31/1/2018, determine whichever is less. That answer, compare it with the actual cost of acquisition, determine whichever is higher. I accept. Had you purchased it on 31/1/2018, what would have been the cost? Because till that time it is exempt. So compare it and determine whichever is higher. If you have purchased it after 1/4/31/1/2018, take only the actual purchase price. Read through the table once. Question number 5. Usha purchases 1,000 equity shares of a company, unlisted company. So it has nothing to do with listed companies, etc. not that special provision, normal. At 30, paying brokerage on one person in 1996, she gets 100 bonus shares in August 2000. She again gets 100,100 bonus shares on February 2000. FMB as on 1/4/2001 is rupees 80. This will only prevail for opening 1000 shares and this 100 bonus shares. 100 bonus shares issued before 1/4/2000. On 1st January 21, she transfers all these things for 200 per share, brokerage being 2%, compute capital gains. Read through. How many shares? First 1000, next 100, 1100, plus another 1100, 2200 shares. First 1000, then 100, 1100, then another 1100, 200 shares. 2200 shares. Okay. 2200 into sale value 200 per share. Yes, cost of transfer at what percentage? Brokerage being 2%. Net consideration. Net consideration. Okay. Net consideration 4 lakh. Okay. Less ICOA. Less ICOA. Okay. Now 1000 shares which is purchased plus 100 bonus shares allotted before 1/4/2001. Okay, 1100 into what is the FMB as on 80 into 301 by 100. Repeating 1100 into 301 by 100. Gross LTCG. Question number 6. Yamuna had purchased 2,500 shares in April 14 for 46 paid STT. She sold them in 2020 310. Should she has purchased it in April 14 before 31 118? Okay. Through a recognized stock exchange. Well, compute capital gain in each of the following circumstances. FMB is 110, FMB is 40, FMB is higher of the above. If there are more than one FMB, please consider whichever is higher. If there are more than one FMB, please consider whichever is higher. Okay. First three questions I will answer, then go to fourth question, then go to 4, 5, 6. First three questions I will answer first. Okay. Question number 6 for listed shares. Question number 6, listed shares. Case 1. Case 2. Case 3. Value of consideration. Okay. 2,500 shares. She sold it for 310 per share. 2,500 into 310. Many of you might have the doubt, can I claim cost of transfer, that is STT paid? Okay. No, you cannot claim. No, you cannot claim. Okay. STT cannot be claimed. STT and CTT are allowed only if it is held as stock in trade. But I have paid. I will give you some other concession weight. I will give you some other concession weight. Net consideration. Yes. Cost of acquisition, I'm meaning it. Indexed cost of acquisition, I did not write. Cost of acquisition. For listed shares, no indexation, even if it is a LTCA. So for listed shares, no indexation, even if it is a LTCA. Please understand how to work. Step 1, sale value or FMV as on 31/1/18, whichever is less. Step 2, answer of step 1 or COA, actual COA, whichever is higher. Okay. Case wise can we go? Okay. 2,500 shares, 110 or 310, 110 or 310, 110 or 310, whichever is less, 110. 110 or 46, 110 or 46, whichever is higher, 110. So 2000, how many share? 2500 into 110. Repeating how I got 310 or 110, whichever is less. Step 1, 110. Step 2, that which actual cost, whichever is higher. So 110. Second case, 310 or 40, 310 or 40, whichever is higher, whichever is less, 40. 40 or 46, whichever is higher. So 2,500 into 46. 310 or 118, whichever is higher amongst these three things, you will always take 310 or 118. 118, 118 or 46, 118, 2,500 into 118. gross LTCG under section 112A, gross LTCG under section 112A, 5 lakhs, 5 lakhs. Gross LTCG under section 112A is 5 lakhs. Out of the above LTCG, rupees 1 lakh will not be taxable, exempt, and the balance is taxable at 10%. The balance is taxable. That's why I am not giving you indexation benefit. Non-resident taxation, tax rate 10%, no indexation. Resident taxation, tax rate 10%, no indexation. That's why I'm not giving you 1 lakh, I'm giving you exemption and taxing you at 10%. So I am not giving you the benefit of indexation. In case A, had Yamuna purchased the shares for 330, what would be the gain? E. Compute the tax payable by Yamuna, assuming that she don't have any other income and capital gain is the only source. F. On May 2019, she was allotted 2 shares for 1 share. FMB as on 31st January is 110 per share. Read through. I'm not answering E now. I will answer case D and F. Case D and F. I'll do it separately. Less cost of acquisition. Okay, okay. 310 or 330. 310 or 330. Oh, she had purchased it for 330. Sorry. She has purchased. Okay. 310 or 110, whichever is less. 110. 110 or 330. She has purchased it for 330. 110 or 330, whichever is higher. Okay. Less cost of acquisition. First step. Okay. 310 or 110, whichever is less. So 110 will prevail. Second step, 110, that is answer of step 1, or 330 purchase value, whichever is higher. So 330 will prevail. So 2500 into 330. So gross LTCL original shares, I had 2,500. Bonus allotted in May 2019. May 2019, we allotted the shares there 2 for 1. Okay, so this divided by 2. Total number of shares, I should have given that full form. Okay, 1 share for every 2 shares. You hold 2 shares, 1 share. But sorry, I didn't do it. In the typing, I was not concentrating there. 3,750. Full value of consideration, nothing but 3750 into 310. 3750 into 310. Okay, 3750 into 310 less COA, less cost of acquisition, only for 2,500 shares. Okay, 310 or 110. 310 or 110. It's a continuation of, okay. Okay, 310 or 110, 110 or 46. So 110 into 110. Because for bonus shares, you should not put it is allotted after the specified date. So gross LTC. One minute. About the previous question, I'll come later. But generally, I want it. This question is not about this part, friends. This question is about how to cost of acquisition, the 2 steps, and why I am not indexing is because I am giving you some other benefits. I'm giving you some other benefits. We are moving into slum sales. I believe again slum sales will be May 22 question because there are some amendments, especially goodwill will not be forming part of an asset. So I believe it will be a May 22 question. Also, November it will come again in May is my opinion. As I told you, why I am not doing assessment, okay, since my fast track is for exam oriented. Okay, I will one question I will do it once in assessment of firm, but dissolution of firm, the entire law has changed. Section 9B has been introduced, and so when the law changes, they will not be asking a question. A new section has been introduced for that purpose. That's why I'm not taking up dissolution of a firm as an area now. But in assessment of firm, briefly we'll touch upon. Question number 7. A is a proprietor of Akash Enterprises having 2 units transferred on 1/4/20 1 unit of slum sales for a total consideration of 25 lakhs. Unit 1 was transferred, started in the year 6/7. The expenses incurred was 28,000. Balance sheet, own capital, revaluation reserve. Remember, revaluation should never be a concept in income tax law. Revaluation is never a concept. Bank loan, 70% for unit 1, trade creditors, building, machinery, debtors, other assets. Okay, right? Okay. Okay. Revaluation reserve is for building. No individual value of asset is considered. Other assets include patent which was acquired on 1/7/18 for 50,000, on which no depreciation has been so far charged. Compute capital gain. Interesting question. Please read through. First, I will write the base law so that you are clear. Slump sales means selling and part of an undertaking without assigning values for individual assets and liabilities. Okay, slump sales means selling a part of an undertaking, okay, a unit of an undertaking without assigning values for individual assets. If I know the individual assets and liabilities, I will calculate, but without assigning values for individual assets and liabilities. Net worth will be taken as cost of acquisition, no indexation. If unit is in existence for more than 36 months, then LTCA. Okay, if the unit is there with you for more than 36 months, LTCA, but I will not provide you indexation. Okay, I'll not provide you indexation. Net worth means asset value minus liabilities. Asset value, non-depreciable asset, that is land, book value, or original cost. Sorry, actually, original cost. No revaluation, nothing, original cost. Depreciable asset, WDV as per IT law, if depreciation is not provided, we should provide and arrive at. In this question, they have given patents, they have not depreciated. I should provide and arrive at. I should provide and arrive at. So, depreciable asset, other assets, book value. This is how you have to take that. So, net worth will be computed and it will be reduced. So, now let us go to Computation of net worth. Computation of net worth. Building 12 lakhs, and this revaluation is because of building 12 minus 3. Building, okay, 9 lakhs. Why 9 lakhs? 12 lakhs minus 3 lakhs. Machinery 3 lakhs. Debtors 1 lakh. Other assets excluding patent, because other assets is 150. Okay, other assets include patent which is acquired for 50, on which I have not provided any depreciation. So 150 minus 50, 1 lakh, other assets. Now coming to patents acquired on 1718. 1718 is 50,000 less depreciation at 25%. We all know the depreciation for intangible is 25%. Value on 1419. Less depreciation at 25%. So value on 1420. Wherever they have not provided depreciation, I will provide and find out. I will provide and find out wherever they have not provided depreciation. But I need the income tax value only. If they have given you book value and income tax value, company law value and income, take income tax value only. Less liabilities. Less liabilities. Bank loan 2 lakhs into 70%. 2 lakhs into 70% bank loan. Creditors 1,50,000 into 25%. 1,50,000 into 25%. Net worth, that is assets minus liability. Net worth, that is assets minus liability. I'm getting 12,50,625. 12,50,625. One lakh is exemption limit, not tax limit, Prabhat. 1 lakh is exemption. So if there is 5 lakhs of LTCG under 112A, 1 lakh not taxable, remaining 4 lakh into 10%. Not tax. Exemption is for income. Full value of consideration 25 lakhs less cost of transfer 28,000 net consideration less COA, nothing but net worth gross LTCG You cannot index it. It is gross LTCG. I'll do one more question. Don't worry, at a later stage. If we have loss under 112A below 1 lakh, then what will be the treatment? It will not be carried forward. It will not be carried forward. And if the income is less than 1 lakh, not at all taxable. Not at all taxable under 1 lakh. But loss cannot be carried forward. Question number 8. In order to save time and to mitigate cost, assessee negotiated the sale consideration, get it enhanced by the authorities. AO failed to treat this transaction as compulsory acquisition as the sale consideration stood negotiated. Is the AO justified? No. Balakrishnan's case law, Supreme Court judgment. Okay, I'm just writing the Balakrishnan's case law. I know you can write the judgment. You can refer to the main answer also, solution book also. Okay, where if it is negotiated also, it doesn't change the characteristic. Land was acquired under Land Acquisition Act, so it becomes a compulsory acquisition. Negotiation will not change the characteristic. Negotiation will not change the characteristic. Assessee entered into an agreement to sell with a builder, which provided both parties were entitled to specific performance of the agreement. Under the agreement, assessee gave permission to the builder to start construction on the land. Pursuant to the agreement, a POA was entered by the assessee to a director of the builder company to execute and join in execution of the sale agreements of sale deeds in respect of the subject property after development. Subsequently, a memorandum of compromise was entered between the parties. Clause 3 of the compromise deed confirmed that the assessee had received 4.68 crores out of the agreed sale consideration. Clause 4 recorded that the balance 1.05 crores towards full and final settlement in respect of the agreement entered into would be paid in 7 post-dated check. Clause 5 stated that the last two checks should be presented only upon due discharge of discharge certificate. The last checks were given to the assessee, in which year the assessee is liable to tax. This became one of the key factors in a case law. The question was drafted by me to remind you, to help you understand a particular case law. Okay, my dear friends. Seshasai Steel, you all know that when you enter a POA, it is like transfer of property. Any transaction which enables the enjoyment of immovable property be considered as enjoyment perpetual to a owner, therefore for being transferred under section 247 and levy of tax. The definition of the term transfer includes transfer of possession of property on partial performance of a contract. Section 53A of Transfer of Property Acts, where I enter a power of attorney. The object of this provision is to bring into any de facto transfer of immovable property held by Supreme Court. that on receipt of the last check, the right of the immovable property stands extinguished and capital gains needs to be okay on receipt of the partial performance. I don't know when the property is transferred, but by receiving the last check, okay, it stands extinguished, and you can no more immediately it will be taxed. No more other clauses are not fulfilled, other things are not fulfilled. He is yet to sell the flats. These things does not matter. Okay, when he is selling is not a problem. As far as I am concerned, when I transfer through a power of attorney, today all properties are transferred to POA, which is going to be subsequently sold. As soon as I receive the consideration, partial performance of the contract is over, and I am subjected to tax immediately. Subjected to tax immediately. Okay, okay. I am going to take an important provision now for all of you. I'm going to handle an important provision now for all of you. Okay. The combination of three sections, section 43CA, immovable property held as stock. Section 50C, immovable property held as capital asset. Section 56, gift received of immovable property and inadequate consideration. These three things I am going to see now. These three things. The first two things are seller's perspective. The third thing is buyer's perspective. Shall I again repeat? The first two things, 43CA and 50C, are seller's perspective. The third thing, section 56, is buyer's perspective. 43CA applicable. Okay. So first let me think about section 43CA and 50C. Actual sale value or stamp value, whichever is higher. One amendment, however, if stamp value does not exceed 110% of actual consideration, then actual consideration will be taken. Okay, this is the amendment, 110%. Section 56 for the receiver. Section 56 for the receiver. Inadequate consideration is equal to difference between stamp value and consideration paid. If inadequate consideration exceeds 50,000, whole of inadequate consideration taxable. If the inadequate consideration exceeds, it's there in the theory, don't worry. In various places I have written, if inadequate consideration exceeds 50,000, whole of the inadequate consideration becomes taxable for me. However, where the difference is only 10%, then not taxable, even if it exceeds 50,000. So this is an amendment here also. Okay. Now the basic question is stamp value on which date? Stamp value on which date? Advance received on approved modes. Date of agreement. Advance not received or received in unapproved modes. Unapproved modes are cash check, bearer check, cross check. Date of registration. This is the provision 43 CA, 50 C, 56. I have written, don't worry. If you look at 43 CA, I have written stamp value also, on which date also, in 56 also I have written. Now I want you to recollect once, remember to just understand. Are you a property dealer? So for him, unsold apartments, unsold land is stock in trade. He's a property dealer. Sold a building in the course of his business to his friend Rajesh, who is an automobile dealer, for 100 lakhs on 1/1/2001 when the stamp value is 120 lakhs. The agreement was, however, entered into on 1/9/20 when the stamp value was 108. Hari received an advance of 15 lakhs by NEFT from Rajesh on the date of agreement. Mr. Hari has purchased this building on 12/7/19. This is part A. We will go to part B later. First, we will do this. Part A. Sale consideration. Actual sale value. Actual sale value. Sold the building for 100 lakhs. Okay. I'll write here itself. Section 43 CA is applicable. Stamp value on date of agreement as advance is received by approved modes. Stamp value on the date of agreement as advance is received by okay. Stamp value, the agreement on the date of agreement, stamp value is 108 lakhs. 110% of actual sale value. Since stamp value does not exceed 110% of actual consideration will be taken as sale value. So your sale value will only be 1 crore because stamp value has not exceeded 1 crore 10 lakhs. Only if it exceeds 1 crore 10 lakhs, I will take the stamp value. Okay, less cost of purchase. Hari has purchased this property. Hari has purchased this property. Hari for 50 lakhs in 2019. Business profit. So here is a case where he has got the advance through an approved modes. That's why you are getting this benefit. NB. Mr. Ravi, a retail trader, so nothing to do, sold his residential property to Mr. Valish, a wholesale trader, for 50 lakhs when the stamp duty was 70 lakhs. The agreement was, however, entered on 1/8/2020 when the stamp duty was 55 lakh. Mr. Varavi has received a down payment of 5 lakhs through cross the check unapproved moves from Mr. Balish. Okay, Mr. Balish has purchased this building for 32 lakhs on 17/8/19. 17/8/2019. 17/8/2019. He is selling it on 1/2/21, less than 2 years. So it's a short-term capital asset. It's a short-term capital asset, remember. For Hari, residential house, section 50C. Okay, section 50C is only applicable. Sale consideration. Sale consideration 50 lakhs. Stamp value on the date of registration as advance is received by unapproved modes. That is, you have received it by cross the check. So, stamp value on the date of registration 70 lakhs. 70 lakhs. Okay, here. Since stamp value exceeds 110% of actual sale value, stamp value will be considered as full value of consideration. So you will take 70 lakhs. You will take 70 lakhs. Reason being, it is more than 55 lakhs and I will take it on the date of registration only because it is as if you are not COA. It's a short-term capital asset. So I will take COA 32 lakhs, 32 lakhs. Okay. Gross STCG. Gross STCG. Let's go green. Okay. Gross STCG 38 lakhs. I'm not stopping the answer for Harila for I'm not stopping the answer here. I'm giving you a value added answer that is for Valish. For Valish. Inadequate consideration. Actual consideration 8 is 50 lakhs. Stamp value on date of registration as advance is paid by unapproved modes 70 lakhs. Okay, 110% of actual consideration paid. Stamp value exceeds. So I will take 70 lakhs. Inadequate consideration. Inadequate consideration. Difference between stamp value and actual consideration, okay, is 70 lakhs minus 50 lakhs. This is taxable under IFOS. This is taxable under, my dear friends, okay, taxable under IFOS section 56 because the inadequate consideration exceeds 50,000, also exceeds 110% of actual consideration. So the whole of the inadequate consideration becomes taxable in IFOS. This is important to understand. These type of questions do come. That is, what date? Now you can easily remember, and how it is taxable to various parties. 43CA, 50C and 56 are interrelated. I'll work out one more question on this when we do IFOA. Stopping here for the day. We'll continue tomorrow morning.